Hi, welcome to your next market update. And just to let you know, for those not familiar, on our website we have a candlestick glossary. If you go to candlecharts.com and you'll see the glossary and you'll see a list of all the candlestick signals. They don't go into the detail as we do in our in-depth education, obviously, but it's a good refresher for those who are familiar with candlesticks or for those new to candlesticks. It's a great way to see what the pattern looks like. So for any of the candlestick signals we talk about in these market updates or educational resource called Highlights or educational newsletter that you get as a member of the candlecharts.com family, feel free to go to the website and check out the glossary. So let's look at the first pattern we're going to be talking about today. This is a hammer. And the hammer, this is a weekly chart. And although this is a Euro US, don't worry if you don't trade Forex. Everything we talk about in this market update and all our sessions can be used in all markets and all time frames. So there are a lot of nuances with candles. And in fact, speaking of nuances, for those who are going to be attending my first ever full day webcast, which is going to be on February 11th. I'll be going over a lot of the nuances with candlesticks. We'll talk about one in a minute or so. But for those who have not taken advantage of the special pricing, which we have for the next day or so, go to this link to find out about the webcast. It's going to be available also as a recording for 1 year. So even if you can't attend the full session as a webcast, you will have access to the video for a year. I wanted to do a full day webcast because we get a lot of people who like that live interaction with me, but don't want to have the expense and hassle of traveling and hotel renting and all that stuff. So anyway, getting back to this hammer, one of the nuances you could do with candlesticks is use them as potential support or resistance. So the low of the hammer becomes a potential support area. So see how that was successfully defended here. And same thing over here on the weekly chart. So the market had a rally because it was near a support area. Notice how the doji was showing us the bearish momentum was losing steam, so the market rallied. But what I'm looking at here now is a daily chart of the euro. The prior chart was a weekly chart. And I have my favorite Western indicators, and I'll obviously be talking about them in the full day webcast. But one of my favorite Western indicators are two moving averages that I use to define longer term trend. So I'll look at a 20-day and a 50-day moving average, and the 20-day is under the 50-day moving average. So that tells me the intermediate term trend is down. So yes, although the market rallied from the 126 level because of that hammer that was made many months ago as a support area, the longer term trend is down, and we're now at a resistance area. Notice these horizontal blue lines. This was prior support. And prior support, once broken, I call this change of polarity, often becomes resistance. So you can see the support zone became resistance here in December. We're now at that resistance area. So what this means is we really have to close, the market really has to close above these highs, I would say above 133 to be safe, to say that the resistance area was broken in the euro dollars. For now, my feeling is that the market is at a resistance area. If it starts pulling back from here, the risk is down to at least the 128 area. But a close above 133 to me would be a breakout, and my next upside target would be about the 135 area. Now let's look at the crude. Here we have bearish engulfing patterns, black wrapping around the white, black wrapping around the white. So you can see the 104 area is very, very important resistance. And in fact, since we stalled at these bearish engulfing patterns, we've essentially had lower highs. And if you look at this and you kind of mentally draw a support line right around 97.5, we have what's called a descending triangle. So actually between 97 and 97.5 is support. Notice something interesting here, a hammer, okay, a bullish engulfing pattern, a piercing pattern. So it looks like we have good support right around 97, 97.5, but these lower highs show that demand is stepping in at supply is stepping in at lower highs, and that could be a bearish scenario. But a descending triangle is not confirmed until we take out the low, so that would be 97. And in that case, on a close under 97, my downside target, based on the descending triangle, would be around the $90 to $91 area, which would be the lows over here. But just to give a sense of how significant this 104 resistance area is, let's look at the weekly chart in crude. And you can see this is the weekly chart, and look at this around 105 and 104. Look at all the resistance that the crude has had since May of last year. So the market really has to close above 105 to give us an upside target to the high of the bearish engulfing pattern up at 115. And when I talk about close above 105, I'd want to see a weekly close. Now, this red line I drew, this is showing a huge inverted head and shoulders. Left shoulder, head, right shoulder. And notice how over the next week or two, the neckline of the head and shoulders is also intersecting with this resistance area here. So that's why the 105, maybe a little higher, 105 and a half, 106, really needs to be broken to say that, yes, then we're going to 115. But for now, we're at a major resistance area as defined, or if we rally to around 104, 105, crude would be at a major resistance area as defined by the prior highs and the neckline of the inverted head and shoulders. Okay, good trading, everybody, and look forward to seeing many of you at my seminar on February 11th.